Patience and discipline beat adrenaline and impulse in the long run. When most people think about trading, they imagine excitement. They picture themselves spotting huge trends, making enormous profits overnight, and feeling that adrenaline rush every time the market moves. Charts with sharp spikes and dramatic candle patterns seem thrilling. Social media traders post screenshots of massive gains, and it all feels like the fast track to wealth. But here's the truth. Most of those flashy trades aren't repeatable. They rely on luck, timing, and taking big risks. While one person might win big once, the losses that follow often wipe out the gains. Trading is not a game of moments, it's a game of consistency. And consistency rarely comes with drama. That's where boring trading comes in. Boring trading is about predictability, discipline, and repetition. It doesn't involve chasing the market or reacting to every news headline. It's about finding setups that work, defining your risk, following strict rules, and executing the plan over and over. Some traders hear the word boring and immediately think it means doing nothing or missing opportunities. That's not true. Boring trading means you focus only on setups that give you a good probability of success, manage your risk properly, and let compounding work its magic over time. The trades themselves may not be exciting, but the results are steady and powerful. One of the reasons boring trading is so profitable is psychology. High-risk, exciting trades trigger our emotions: fear, greed, and hope. You feel the rush when you see a potential massive gain, but you also feel intense stress when the trade goes against you. That stress often leads to impulsive decisions, moving your stop loss, doubling down, or taking revenge trades to win back losses. Over time, these emotional reactions can destroy consistency and profit. Boring trading, on the other hand, keeps emotions in check. When you risk the same amount every trade and aim for modest, achievable gains, each trade feels manageable. Losses are tolerable, and wins feel satisfying without creating overconfidence. Over time, your psychology aligns with your strategy. You become disciplined, patient, and consistent, qualities that create long-term profit. Boring trading also simplifies decision-making. Instead of analyzing dozens of indicators or trying to catch every market swing, you focus on a few high-probability setups. You define entry points, stop-loss levels, and profit targets. You follow these rules without second-guessing. This reduces mistakes, prevents overtrading, and protects your account from unnecessary risk. Another major advantage is risk management. In exciting trades, traders often increase position size or risk too much because they are chasing big gains. When the trade goes wrong, losses are magnified. Boring trading limits risk on every trade. The profits may be smaller individually, but they are predictable, repeatable, and safe. Over time, this creates steady account growth instead of wild swings. Even successful traders admit that boring strategies outperform flashy ones. The market doesn't reward excitement, it rewards discipline, patience, and predictable execution. Big wins are tempting, but consistent small wins compound over time into substantial growth. Exciting trades may feel satisfying in the short term, but they rarely sustain long-term profit. To put it simply, boring trading is like planting a tree instead of trying to find hidden gold. The tree grows steadily, giving shade, fruit, and long-term benefits. Chasing gold feels exciting, but most of the time, you end up exhausted and empty-handed. The key is repetition, patience, and letting small gains accumulate quietly. Emotions are the silent account killers in trading. Trading is not just numbers and charts, it's psychology. Most traders fail not because their strategy is bad, but because their emotions take control. Excitement, fear, greed, and hope drive decisions, often causing inconsistency and losses. Think about it. When you see a chart spike suddenly, or notice a potential breakout, your brain lights up with adrenaline. You feel like this trade could be life-changing. That rush makes you want to enter immediately, sometimes without proper analysis. The excitement clouds judgment. You risk more than you should, or ignore your rules because you believe this one will be different. Emotional trading is dangerous. Fear makes you hesitate, potentially missing high-probability setups. Greed tempts you to increase positions or move stop losses, chasing bigger rewards. Hope convinces you to stay in losing trades, waiting for a reversal that may never come. These emotions, combined, reduce consistency and destroy long-term profit potential. Boring trading works because it removes the emotional component from every trade. By focusing on setups with defined risk and achievable profit, each trade feels manageable. Your mind stays calm, and you can follow your strategy without being swayed by short-term market noise. Consistency also creates confidence. When you execute the same plan repeatedly and see steady results, your emotions stabilize. You stop chasing excitement and start trusting your method. Predictable outcomes reduce fear, greed, and impulsiveness, which allows your account to grow steadily. Let's consider an example. Imagine two traders looking at the same stock. Trader A sees a huge spike and jumps in, hoping for a massive profit. Trader B identifies a smaller, predictable setup, entering with proper risk management. Trader A experiences highs and lows, swinging between excitement and panic. Trader B has smaller profits, but they compound reliably over time. Which trader ends the year ahead? The calm, predictable one almost always wins. Another psychological factor is loss tolerance. Exciting trades often involve high risk, meaning losses feel heavier. A single loss can trigger revenge trading or impulsive adjustments to win back the money. Boring trading limits loss per trade, so even if you lose, the impact is minimal, keeping your mind clear and disciplined for the next trade. Interestingly, research in behavioral finance supports this. Traders who focus on consistency rather than chasing huge wins tend to have lower stress, better discipline, and more sustainable results. Emotional swings directly correlate with account volatility. Minimizing emotional triggers means minimizing mistakes and maximizing long-term profitability. Even the most experienced traders admit that boring trades are their bread and butter. The excitement of one massive trade is appealing, but it is unreliable. Real growth comes from repetition, proper risk management, and patience. Markets reward traders who execute their strategy consistently, not those who chase adrenaline. By understanding the psychological pitfalls of excitement and embracing consistency, traders gain two major advantages: emotional stability, calm decision-making, fewer mistakes, and better discipline. Predictable growth, compounding small, consistent gains over time, building long-term profitability. Sometimes the quiet approach wins where excitement fails. Emma and Liam started trading at the same time, with the same knowledge, same market conditions, and same capital. But their approaches couldn't have been more different. Emma loved the thrill of the market. She scoured charts for big moves, chased high volatility, and entered trades she believed could make her rich quickly. Every time the price spiked, her heart raced. Every new breakout felt like an opportunity she couldn't afford to miss. At first, it felt amazing. Her account saw some huge spikes in profit, and she felt invincible. She shared screenshots of her gains with friends and celebrated every large win. But excitement comes at a cost. Every big gain was followed by a bigger loss. She would enter impulsively, often skipping her own rules. Stops were moved, risk was increased, and when trades went wrong, she doubled down to recover quickly. Soon, her account began to fluctuate wildly. The emotional roller coaster, exhilaration, fear, regret, made her tired and stressed. By the end of the month, many of her gains had disappeared. Liam, on the other hand, took a different approach. He called it boring, but it was disciplined. He only entered trades that met his strict criteria: clear setups, defined stop losses, and achievable targets. Each trade risked a small, consistent amount relative to his account. He didn't chase the market or let emotion dictate decisions. Every trade followed his rules, without exception. At first, Emma laughed at Liam. "Your trades are so slow, you're barely making anything," she said. But Liam didn't mind. He knew that consistent small wins would compound over time. He stuck to his method, ignored the market noise, and focused on execution. Over the next few months, a pattern emerged. Emma's account went up and down like a roller coaster. One week she was thrilled, the next week frustrated and exhausted. She lost confidence, and fear of missing opportunities made her trade even more impulsively. Liam's account, however, grew steadily. Every small win built confidence. Losing trades were minor setbacks that didn't affect his psychology. He repeated the same plan over and over, and over time, his small, predictable gains accumulated into significant growth. The turning point came when Emma realized what was happening. One afternoon, she compared her account to Liam's. Despite her flashy trades and high-risk moves, she had barely grown over 3 months. Liam's boring approach had outperformed her by a noticeable margin. She finally understood. Consistent, predictable trades beat exciting, high-risk trades every time. This story illustrates a key lesson. Big wins are tempting, but consistency wins in the long run. Emma's impulsive, exciting approach created emotional stress and inconsistent results. Liam's boring, disciplined trading led to reliable growth, reduced stress, and long-term profitability. Notice how Liam's method had multiple advantages: controlled risk, losses were manageable and didn't wipe out gains. Emotional stability, fewer highs and lows allowed clear decision-making. Repetition and habit formation. Each trade reinforced discipline and confidence. Predictable compounding. Small wins added up steadily, producing significant growth over time. Even though Liam's trades felt boring in the moment, the results spoke for themselves. Markets reward consistency, discipline, and patience, not adrenaline. Emma eventually adapted. She simplified her strategy, followed rules more strictly, and stopped chasing excitement. Slowly, her account stabilized and she started seeing consistent growth. This story is relatable because many traders start like Emma, chasing excitement, believing that huge wins are the key to success. But the truth is the opposite. Boring trading is not only less stressful, it is more profitable. Steady wins over time outperform flashy wins in a day. Now that we've seen the story of Emma and Liam, it's time to understand why boring trading works in practical terms. The secret isn't magic or market timing, it's consistency, risk management, and compounding small gains. Imagine you take 5 trades per week. A boring trader like Liam risks a fixed small percentage on each trade, say 1% of his account, aiming for modest, achievable gains. He follows his rules. The setup, entry, stop loss, and target are all predefined. Each trade has predictable risk and reward. Even if he wins only 3 out of 5 trades, his losses are small and manageable. The gains, while modest individually, add up steadily over time. Now compare this to Emma, chasing big wins. She risks more per trade, moves stops impulsively, and often exits winners too early. One big win may feel amazing, but losing 2 trades wipes it out. Her account fluctuates wildly, her confidence suffers, and she may make emotional decisions to recover losses. Boring trading removes that unpredictability. By targeting consistent outcomes, traders protect their account from large drawdowns. Small gains compound. Think of it like a snowball rolling down a hill. It starts small, but consistency grows it into something substantial. Let's break it down with numbers. Suppose Liam risks $100 per trade and aims for a $100 gain, 1.1 risk reward. He takes 10 trades, wins 6 and loses 4. He nets $200 overall. Emma, aiming for $300 gains per trade with $100 risk, 1.3 risk reward, takes 10 trades, wins 3 and loses 7. Even though the winning trades were larger, her net result is only $200, the same as Liam, but with more stress, volatility, and risk. In reality, the odds often favor the steady approach because emotional mistakes and inconsistent execution reduce the effective win rate in high-risk trades. Boring trading also allows more trades safely. When each trade's risk is small and predictable, you can continue trading without fear of catastrophic losses. This repetition builds experience, confidence, and mastery over your strategy. Over time, repeated small wins create compounding growth, something flashy trades rarely achieve due to their higher risk and emotional volatility. Another benefit is mental clarity. Boring trading reduces emotional highs and lows. Fewer decisions are made on impulse. Each trade becomes a task executed according to plan rather than a gamble based on excitement. With less stress, traders can focus on learning, improving setups, and refining execution. Mental fatigue decreases and performance improves over time. Risk management is also central to boring trading. With small defined losses per trade, even a series of losses won't devastate the account. Traders can recover calmly, maintaining strategy adherence. In contrast, chasing big profits often leads to moving stops, over-leveraging, or revenge trading, all of which increase risk and reduce consistency. Consistency compounds more than excitement. Imagine compounding 1% gains repeatedly over months. Even with small trades, the account grows exponentially. Flashy trades may provide temporary spikes, but rarely create stable long-term growth because of volatility, stress, and emotional decision-making. Finally, boring trading reinforces good habits. Discipline becomes automatic. Every trade follows the plan. Record-keeping, analysis, and routine become natural. Over time, these habits solidify into long-term profitability. The strategy becomes repeatable, scalable, and predictable, key ingredients for sustainable success. In short, boring trading works because consistency compounds gains, small wins add up over time, risk is controlled. Losses are manageable and predictable, emotions are minimized, fear, greed, and stress are reduced, habits and discipline improve. Repeated execution strengthens skill and confidence. Account growth is predictable. No wild swings, fewer mistakes, steady progress. Profitable trading doesn't require excitement. It requires patience, repetition, and discipline. Boring trading may feel slow at first, but it builds a strong foundation for long-term success, unlike flashy, high-risk trades that provide temporary thrills but inconsistent outcomes. Big excitement rarely beats quiet consistency. We've explored the concept, psychology, story, and mechanics of boring trading. Now it's time to make it actionable. If you want to trade profitably and reduce stress, here are practical steps you can implement today. 1. Define your setups clearly. Choose a few high-probability trade setups that work for you. These could be based on support and resistance, trend lines, or simple indicators. Avoid overcomplicating with dozens of tools. Simplicity improves focus, reduces mistakes, and makes execution consistent. 2. Set your risk per trade. Decide how much of your account you're willing to risk on each trade, ideally a small, consistent percentage. Most successful traders risk 1–2% per trade. This keeps losses manageable and ensures that no single trade can significantly damage your account. 3. Follow rules strictly. Every trade should have defined entry, stop loss, and take profit levels. Avoid moving stops or targets impulsively. Boring trading is about repetition. Follow your plan without hesitation, even if the market tempts you to deviate. 4. Keep a trading journal. Record every trade, setup, entry, exit, emotions, and mistakes. Reviewing your trades helps identify patterns, refine strategy, and reinforce discipline. Over time, journaling improves your decision-making and builds confidence in your system. 5. Be patient. Sometimes, the best action is no action. Wait for trades that meet your criteria. Avoid the temptation to enter the market just to feel like you're trading. Boring trading relies on waiting for perfect setups rather than chasing every market move. 6. Focus on compounding. Small, consistent profits accumulate. Think long-term. Even trades that earn modest returns add up over time when executed consistently. Avoid chasing huge gains per trade. Instead, let compounding work quietly in your favor. 7. Manage emotions. Stress, fear, and greed are natural, but boring trading reduces their impact. By controlling risk and following rules, you avoid emotional reactions that lead to mistakes. Remember Emma and Liam. While Emma's exciting trades created highs and lows, Liam's calm approach protected his account and mind. Summary. Key takeaways. Excitement is deceptive. Thrilling trades may feel rewarding, but they often lead to inconsistent results. Consistency is profitable. Small, repeatable wins compound into long-term success. Discipline beats adrenaline. Following rules, managing risk, and avoiding impulsive decisions protects your account. Psychology matters. Emotions influence trading more than strategy. Boring trading minimizes emotional mistakes. Habits create success. Repetition, journaling, and routine solidify good trading behavior, making profits predictable over time. By focusing on boring, disciplined trading, you reduce stress, avoid impulsive mistakes, and grow steadily. While it may feel less exciting than chasing massive wins, boring trading is the most profitable approach in the long run. If you found this video helpful, like, subscribe, and hit the notification bell for more trading strategies, psychology insights, and actionable tips. Share your experiences in the comments. How has focusing on boring, consistent trades improved your results? Join a community of traders committed to discipline, patience, and long-term growth. Remember, in trading, slow and steady truly wins the race. Patience, consistency, and discipline are your best allies.